What do the investors look for in companies? What are they actually looking for? What do they want in their target companies? Venture capital investment guidelines will help us to be prepared to meet these investors, will give us an idea what are they looking for. In the following slides, we will focus on the key aspects that venture capitalists would look at for investing in growth companies. And as you see, it is growth companies, not just any company. They are looking for potential companies. A sector's growth potential is important for these venture capital. A core pillar of investment funding and investment is to secure exposure to sectors with a strong, identifiable growth potential. These sectors such as technology, media, telecommunication, healthcare, education, logistics, services, and of course, clean technology can be a good target with the growth potential as sectors. Targets, positioning, and operational track record. These venture capital, at the end of the day, they prefer to invest in companies with established and proven business model, focusing on regional funding and investment or market leadership. Not just any company can be the target of venture capitalists. They want a company that can become a leader in whatever they are selling or providing in terms of services. And of course, these venture capital, they are looking always to invest in companies that are already profitable for at least the last 2 to 3 years, or they are in the process of turning profitable. But they prefer companies that are already profitable. They need to know that they will get their money back soon. Again, looking at companies in terms of financial is important, but who's running the company? Of course, it is very important. The management team should be able to demonstrate deep domain expertise and strong track record in their respective industry. They must be expert. They must have experience. They must have their background to support what they are doing, to provide the venture capital with an idea that we know what we are doing. We know what it takes to have a successful company. The business plan is very important to assist in assessing the clarity of the management growth funding and investment and the implementation plan. The business plan will tell us how much money we need, and we can tell the investors how much we need, what we will do in this money, and what are our implementation plan for the future. As for the transaction types, these venture capital, they prefer to provide growth capital to companies rather than cash out to owners, and they seek to generate return. Of course, they're looking to threefold return on their investment, but they prefer to provide the fund for growth, not just for working capital. As for the transaction size, we talked about it before, saying that these investors, the venture capital, they are willing to target companies with amount that can range from $500,000 to $10 million. So of course, this money can be used for further growth, not just for working capital. When it comes to ownership stakes, it varies among these venture capital. Some like to take controlling stake, and a lot of successful ones, they prefer to keep owners in control. Owners who know the business, who know how to run the business. So they prefer just to help, to provide their advice, not more, not less. A case study that you have to look at is the challenge for private equity in the small and medium enterprise space, especially in the GCC area. We all know that the cost to originate and execute a small and medium enterprise deal is probably one of the biggest challenges. Many quality assurance steps need to be taken before a deal gets done. Legal advisors, technical advisors, and financial advisors, they all come at a cost. Here, justifying the efforts in deploying internal resources, mainly people's time, our labor force, into investment could be an issue. Why? Because these investments, they may lead attractive returns in percentage terms, but not in absolute terms. Because the starting base is small. We're still a small business that is growing. They also tend to consume a lot of time after investment is made. Private equity investors at this level, they want to add value to an SME investment. But because their time is the most expensive resource, they need to be involved in a balanced way. Not too much, not too little. That means being efficient in dealing and communicating with the entrepreneur and focusing on things that really matter. As one seasoned private equity investor puts it, he said, you learn how to become better over time. So it all takes time. This efficiency should affect also the cost of executing an SME deal. And investors learn with time to be very focused on what they want to get from lawyers, accountants, in order to put a reasonable cap on legal and accounting fees, and focus on the risk areas and the due diligence item that really matters. So as we said, one of the biggest challenges for private equity in the SME space is the cost to originate and execute the SME deal.